Boop boop bop ba dum bum. Boop boop bop ba dum ba da dum da dum da dum ba dum bum. Beep bop boop bop boop bop boop da ba dum bum. Beep bop boop bop beep beep boop bop ba dum bum. Hello, folks. This is Dave Lentz. When I originally did my video on valuing bonds, I I had chopped up the videos or done them in segments, and I had done an initial investments, sort of an introductory video. And so when I got around to actually doing the video on bond valuation, it sort of jumped into things sort of in the middle. And subsequent events have allowed me to sort of do what I'm about to do. And so I'm going to take this opportunity to add this insert before we get into the actual nuts and bolts of valuing bonds. And we will do some examples on the board in a minute, and we'll get back to the regular video, but I'm going to go ahead and do this. So bear with me for a second, and I think that you will find what I'm about to say to be useful, especially for the novices out there. And so with that in mind, here we go. What is a bond? Well, it's a legally enforceable promise to pay principal and interest on time. It's like an IOU, and usually what you have is you have bond issuers who are basically like borrowers, and you have investors who are bond holders. That's typically you, the buyer of the bond. But you're really going to act like a lender to the issuer. Um, I will get to that more about that in a second, but let me just say this: bonds typically are a little bit different. It's you got to look at it as like an IOU. It's a repayment of the loan by the issuer, the company that sold you the bond. They're basically borrowing money from you, the investor, and so they pay you principal and interest. But when they pay you principal and interest under most bonds, traditionally, now there are some exceptions. There is exceptions to everything in the world anymore, but we're just basically going to talk about the plain vanilla type of bond, the traditional type here in this video, pretty much. Uh, they paid a coupon interest rate. That's basically the stated interest rate on the bond over a certain period of time, and at the end they pay all the principal back, what your original purchase price of the bond was, when that we're assuming here that you bought it at initial issue when the bonds were originally issued. More about that in a second also. But but they don't amortize like a mortgage. When you when a borrower, you repays your mortgage, part of your payment is principal and part's interest. That's not the way bonds are paid. The typical traditional bond the investment bond that we're going to talk, bonds that we're going to talk about, they pay all interest and interest only periodically during the term of the bond, and at the end they repay all principal back. So that's one major difference between a sort of a bond and a regular debt or loan type of instrument. Okay, so let's sort of get into it. So that's a bond. It's legally enforceable. Unlike a stock where the issuer has no obligation to pay you any money ever. That's a different video, but in a bond, the issuer, the company that's got its name on your bond, has a legally enforceable obligation to pay you principal and interest on time. Okay, so what are typical bond issuers? Typical bond issuers, well, the biggest one would be the U.S. government, United States Treasury bills, notes, and bonds. That's the biggest one. Those are often thought of as risk-free investments because the whole world economy probably depends on whether Uncle Sam pays principal and interest on its bonds to people who buy U.S. government bonds to finance federal debt. Okay, that's the biggest one. Also, U.S. government agencies, let's say Fannie Mae, Ginnie Mae, Freddie Mac, they issue bonds as well. State and local governments. I used to work for a company called the Virginia Housing Development Authority. We sold bonds to raise funds to make mortgage loans to persons and families of low and moderate income, and we sold bonds to raise that capital. And one thing about that, those are called munis. The Virginia state government, for example, would also do something like that. They would sell bonds to finance their operations or their debt, either one. But the great thing about munis is, and this is something to keep in mind, is that they are the interest payments. The interest payments are exempt from federal taxation. Consult with your tax advisors on all of that, but that's one of the big advantages of local government bonds. Oddly enough, that does not apply to the interest paid on U.S. Treasuries and U.S. government agency bonds. Okay, then there's regular private, like General Motors, private corporations, like General Motors that are publicly traded typically. General Motors, Ford, General Electric, Coca-Cola. They also issue bonds where they borrow money from the public to finance their capital needs. Okay, so those are the big ones. And so what we're going to discuss today in terms of valuation applies to all of these types of entities. So it doesn't matter if it's issued by the federal government, if we're talking about a U.S. Treasury or a government agency or the state or local government or General Motors or whoever. If we're talking about bonds, this applies to everybody. Now, one caveat to that, we're going to be talking about bonds that are traded actively on some kind of secondary market. If Mama and Papa Smith at the local restaurant go out and issue IOUs to everybody in the neighborhood to borrow money, those are not likely to be, traded on any kind of active secondary market. So I'm not talking about that situation. I'm talking about pretty much sort of the more established entities in this video. Okay, that have their bonds traded actively on a secondary market, the bond market. Okay, all right, so next. Okay, let's take an example. GM issues a 10-year bond, let's say that you buy it, with a coupon interest rate. The interest rate stated on the bond is often called a coupon rate. I won't go into why it's called a coupon rate, because, well, in the old days you used to clip these coupons to get your interest payments, but it's often called a coupon rate. Anyways, if it issues a 10-year bond with a coupon interest rate of 4% that's paid quarterly, in other words, say March, June, September, I don't know when in December we'll say, I don't know. Let me see, March, June, September, and December. We'll say, okay, those 4 dates. And it's paid 4%. And what they would do is once, if they sold that bond, and let's say the face value, which is called par value, is $1,000. Let's say you paid them $1,000 to GM to buy this bond when they initially issued it. That means thereafter, for 10 years, they're going to pay you $10 every 3 months for 10 years. And at the end of the 10th year, they're going to pay you back the full $1,000. Okay? Now, let me just make this point and etch this firmly in your mind. If you buy a bond and hold it to maturity, never sell it beforehand, a lot of what we're talking about in this video is not going to apply. You're just collecting interest payments, which are usually taxable, and then you'll collect a principal payment, which is usually not taxable. Consult your financial and tax professional on all this. Don't rely on me for legal or financial advice in this video, but I'm trying to make general points. But by and large, the interest payments are paid, during a period of time, during the term of the bond, and at the end, you get all your principal back. And if you hold it until maturity, then you don't have to worry about a lot of what's stated in this video in terms of bond valuations. What we're primarily concerned about in this video is because a lot of folks out there buy longer term bonds, more than a year, for example, is what happens if you have to sell your bond early. to get your money early because you can't wait for it. Let's say you have a medical emergency, or junior has to go to college, or whatever. For whatever reason you need your money early, you're going to try to liquidate or sell your bond to someone else, and they're going to then assume the right to your payments to principal and interest, but you get cash from them to get liquidated, to get out of the position early. That's what we're primarily concerned about in this video. So it's that sort of situation. Now, like I said, you can hold your bond for 10 years and collect your regular payments of interest and principal, or if you need immediate cash, or you want to sell early before the 10 years is up, you can sell your bond in the bond market to another investor like you. If this happens, he will pay whatever the bond is worth at that point in time, and that may change. And we're going to discuss a little bit why that happens. So we're talking about early selling of your bond to get money early. Okay, what a bond is worth, what its value is at any point in time, is what this video is about. This is mostly about bond values if you sell your bond prior to the bond's final payment or due date. The time value of money. Okay, all right. The whole concept is worth a separate video, and people that major in finance, or people that are into, even anybody that does commercial real estate or something like that, whose job is more dependent on money and cash flows, and accountants and all that stuff, spend maybe 1 or 2 class periods going over how to calculate the time value of money. Suffice it to say that if somebody promised you, $100 100 years from now, what would that be worth in today's terms? Well, that gets to this concept of something that financial people use, this very confusing term, because they use this term to mean so many different things, but they call that discounting. You discount the value of let's say $1,000 in 100 years. You discount the $1,000 that you're going to receive 100 years from now into today's present value. Well, it's obvious none of us probably are going to live to be 100 years old. So what's the value of $1,000 100 years from now? It's not going to be anywhere near $1,000. Probably not even going to be half that. Probably not going to be a quarter of that. And the value that it is today is very, very dependent on what current interest rates are. And the higher the interest rates are today, the less that $1,000 100 years from now is worth. The lower the interest rates are, well, the lower the interest rates are today, well, that will make the value of that $1,000 100 years from now a little bit more, but it's still not going to be worth all that much. But that's the concept. Money to be received in the future has value today, and you can compute that value through present value analysis. And we're going to those concepts are going to be implicit in everything we're about to discuss, but I'm not going to divert from the basic chore here. If you want more analysis of present and future values, I'm going to have to either do another video, or you're going to have to do independent study on that. But anyway, but I think I can make this, in fact, I will make this understandable even with not that much knowledge about that process. But anyway, I will tell you that when we get to these videos in a few minutes, where I do some examples, PV means present value, FV means future value, N is usually the number of payments to be received, or the number of compounding periods in the term of the bond. Now, in finance, you will see I to mean interest rate, the periodic interest rate, or sometimes you see R. And the reason that those two letters are used to represent interest rates is because sometimes interest rates and rates of return to the outsider appear to be used interchangeably. Don't let that confuse you. If you see an I or an R, it probably is referring to some kind of interest rate or discount rate. And I think the examples that I'll use will make that clear, but that's what I or R. because I or R are often also the quote discount rates that are used to calculate present values. So when you hear the word discount, you're discounting, discount. What they're doing is they're present valuing cash flows to be received in the future to today's terms, value in today's terms, present valuing them using discount rates. Don't confuse that with my different discussion about the discount rate that the federal funds, the discount rate which the Federal Reserve Bank uses to affect market interest rates. That is a slightly different use of the term. That's a slightly different discount rate than the discount rates, the discounting we're going to be talking about or maybe referred to in this video. Okay, so that's that. Now, if we invest $1,000 today at 5% for 1 year, then, it'll accrue interest, and in 1 year, it'll be worth $1,050. On the other hand, if somebody asked me what $1,050 in today's terms would be worth, if I know I'm going to get $1,050 1 year from now, how much is it worth today? Well, if the market was such that a discount factor of 5% was appropriate, well, then that $1,050 1 year from now would be worth $1,000 today. So that sort of summarizes what I've been stating on that point. Issuers issue bonds to bondholders who buy the bonds from the issuer. Bondholders then typically get paid principal and interest at a stated rate, the coupon rate, for example, 6% by the issuer. Usually, unlike mortgages, the issuer pays only periodic interest payments until maturity date when all principal is due at once. So here I get to the point where I show you this graphic of the issuer of the bond, who's really that's like General Motors or the United States government, whoever the bond issuer is. And then investors like you buy the bond, you pay the issuer money. This is at the initial issue, the initial public offering. And then thereafter, for the 10 years or the 5 years or however long the bond says, they pay you interest. And then at the maturity date, all of the principal is paid back. So you are basically acting as a lender to the issuer, who is the borrower. And then if you want to sell early, you have the bond market. So the bond market only applies if you're going to sell early before the maturity date of 10 years or 5 years that the bond says it is. If you want to sell in year 2 or 3, for example, you sell it out in the bond market to other investors. That's called the secondary market. Now, let me just tell you this. Once you can buy or sell out there, but if you already own the bond and you sell it, when you sell it, you are going to have a realized and recognized capital gain or loss, which will have tax consequences. But that's how you can actually make money, much like a stock, on selling it before maturity. But you can take a loss too. So that's how if you sell a bond before maturity, you can actually make a gain or a loss like a stock. Now, it'll never be, 95% of the time, it's not, that gain or loss is not going to be anywhere near the size of the gains or losses that you see when you sell stocks, regular common stocks. That's a different video. But you can have a gain or a loss, and it does have tax consequences. You will not have a taxable gain or a taxable loss if you hold a bond until maturity and never sell it in the secondary market. You're just going to collect interest payments, which are going to be taxable, and then you're going to collect principal payments, which are typically non-taxable. Again, consult your tax advisor as to whether this is correct. I'm just making general statements here. And like I said, for munis, oftentimes, municipal government bonds, interest payments are tax exempt, just the interest payments, from state government. Municipal bonds are tax exempt from federal taxes, but typically not from state taxes unless the bonds, for example, if I'm a Virginia resident and I buy a Virginia bond, municipal bond, often the interest payments on that bond are going to be tax-free, and so and it's going to be tax-free not only from federal taxes but also from Virginia taxes as well. But if I bought an Illinois from a different state muni bond here in Virginia, typically the interest payments on that are going to be tax-free from federal taxes, but the interest payment will not be free from state taxes in Virginia. Now, again, consult your tax advisor and all that, but that, as a general rule, is correct. So anyway, but like I said, the big thing to remember is if you sell early, you're going to have a gain or a loss on the bond, depending on the bond's value at the time you sell it in the secondary market to the bond investors, some other bond investor out there. It's traded like pretty much like the stock market. It will seem like a stock market transaction to you, but the brokers will send it to the proper place. Okay. All right. Okay, what determines the market values of bonds? Okay. Bond values the biggest factors are other interest rates for similar bonds, the market interest rates for similar bonds with the same maturity, same default risk, and then depending on other factors, that's also going to have an effect. The big one is going to be what's the interest rate on your bond? What's your coupon rate? What's the length of term of your bond? That's a biggie. That is a biggie. The length of term of your bond. Longer term bonds have a tendency to fluctuate more in value than shorter term bonds do if you have to buy or sell early, if you have to sell it early. You always have to keep that in mind. So if you want to buy a long-term bond because it has a nice juicy interest rate on it, if interest rates between now and the 10-year maturity date out there change, the interest rate on a 10-year, the present value, the market value of a 10-year bond is going to change more than the market value of a 5-year bond or a 2-year bond. Why? Because whoever buys that bond is going to be stuck with the then prevailing interest rate that bond says it is, while some other investor can go out there and buy a bond that's in effect at that time. I think the examples that I'm going to show in the video that follows are going to illustrate this point a lot better than I am right now. But suffice it to say, the longer the term of the bond, just remember, if you have to sell that bond, somebody is either going to be, is going to have to live with that interest rate in the future. Even if interest rates go to 25% and you're holding a 5% bond, the value of that bond is going to be very small, very, very small. So that's going to affect the value. On the other hand, if you've got a 10% interest rate on a 10-year bond and interest rates go to 3%, then the value of your bond, you're going to get 10% for 10 years, while everybody else can only get a much lower rate of interest. Well, the value of your bond is going to go up, potential capital gains territory. All right, so that's how bond values change. Default risk. If all of a sudden, like GE, for example, it becomes known in year 2 of the bond that GE looked great when you bought the bond, but several years later, it has financial hard times, and all of a sudden it looks like that bond is going to go into default. So you bought it in year 1, it looked good, years 1, 2, and 3, but in year 4, GE looks like it's going to go into default. All of a sudden, the value of that bond in the market, what somebody else is going to be willing to pay for that bond, is going to be affected. And liquidity. There's also, for publicly traded bonds, that shouldn't be much of a problem, because liquidity refers to the ability to sell something quickly if you have to, and that we're basically assuming a large degree element of liquidity for the bond. Okay, now this is a very important chart actually, but I'm going to give it short shrift here. When interest rates are set, the interest rate on any bond for new issues for new. This is for if you buy a bond in year one, and then you get, let's say you get a bond for 5%, and then 2 years later, the risk-free rate on Treasuries um, goes up, or if inflation starts to go up, all of a sudden you're going to see new issues have higher and higher interest rates, and that's going to affect the value of your bonds. But all of those factors listed on that chart for new issues, when new bonds keep getting issued after you buy your bond, those are the market rates that are going into effect after you've bought your bond, but they affect the value of your bond in the event you have to sell it early. So that's what we're going to talk about. But those are some of the factors. Okay, 2 key street points. And the first one I just want to tell to everybody who buys Treasury bonds, because they're always touted as risk-free. And indeed, people are not trying to defraud you when they say that. The rate on United States Treasury bonds is usually considered to be the risk-free rate, but that doesn't mean you can't lose money on Treasuries. Anytime you have to sell a bond, even a Treasury bond, early, before its maturity, you run the risk of taking a loss on that transaction for reasons that we've been discussing and will show in the video that you're about to see. So that's the first. Every type of bond, even U.S. Treasury bonds, corporate bonds, muni bonds, any kind of bonds can change in value and are not, if you have to sell early, risk-free. Okay, so you can lose money even on Treasuries if you have to sell early. All right, and the longer, I just want to say this, and like I said, without getting into the long finance discussion, longer-term bonds fluctuate in value more than short-term bonds do. So if you have to sell early, if you ever have an emergency again, and you hold a longer-term bond and you have to sell early, the potential for change, both for either gain or loss, is greater with a longer-term bond than a shorter-term bond. Okay, with that in mind, we're going to get into some examples, and I appreciate everybody basically hanging in there with me, and so enjoy the video. Thanks. Okay, folks, welcome to our discussion today about bonds, investment bonds, in particular corporate bonds, U.S. Treasury bonds, municipal bonds. The discussion today will touch upon all of that. I am going to basically start at the end and move forward, and the reason I'm going to do that, which is probably sacrilegious as far as, well, I was a teacher at one time, and I mean, I would never do what I'm going to do here, but you can always stop the video, and that's one reason why I want to do this. And I want to make the part at the end, which is it's the most important part for today's purposes. I wanted to get it in, but for those of you who are rookies at this, if you hold on and have a little patience, at the end of this video there'll be some stuff that'll be easier to get your arms wrapped around and to comprehend. Anyway, the reason I wanted to do this part first is because for those of you that are a little more advanced, maybe you'll find this useful, especially if you want to know how to calculate some of this stuff. Let me just say this. Let's suppose you buy a Treasury bond. If you buy a Treasury bond, they're supposed to be risk-free. I mean, we don't expect the federal government to default on the payment of its bonds. But nevertheless, that doesn't mean that you cannot lose money on Treasury bonds or T-bills or any bond that pays you a fixed amount of money for a period of time if you have to dispose of it before the maturity date of the bond. And that's what the purpose of this is. So when somebody tells you that something is totally risk-free, one of the things you can't eliminate is the risk of the increase in value or the decrease in value simply because if market interest rates change, and market interest rates always change. the rate on your bond may stay the same, but the point being is if you hold a 30-year bond that's going to pay you 10% for 30 years, that's great. But the problem is if rates in a year from now or 2 years from now go to like 15%, the value of your bond, if you have to sell it before it matures, is going to be less than the face value of the bond. You're going to have to sell it at a loss. By the same token, if interest rates go down to 5% and you're holding a 10% bond, your bond is all of a sudden worth more than what you paid for it. And you can actually profit under those circumstances. And that's true even for U.S. Treasury securities, Treasury bonds. And let me just show you some of this to more or less demonstrate my point. We'll take the middle panel here first. We're going to show you some things about some bond values. And for those of you that have calculators, let me just say this. Sometimes my recollection is that Texas Instruments calculators have different conventions sometimes than say Hewlett-Packard or some of the other calculators. And what that means is sometimes you get negatives in places where it should be a positive number. I'm going to have to leave it to you and your calculator to sort that out with your owner's manual. But with that in mind, and that's especially going to be true pertaining to some of these present value calculations, will show up sometimes. I know it does on mine as negative numbers. They're not really negative. That has to do with the cash flow convention, with the way the calculator is set up. So with that warning in mind, let's take, for example, let's say you have a Treasury bond guaranteed by the federal government, $10,000 bond. It has a coupon payment. It pays you interest quarterly. The annual, this here is, it's a 10-year bond. It pays you, that pays coupons quarterly, but it pays $400 per year. Okay, the coupon, but you divide that by 4, so you get $100 each quarter. Okay, let's say that it matures in 10 years. It's a 10-year bond, but after you bought the bond, interest rates out in the market go to 6%. That means that all bonds of similar risk are now going to be priced as if they were valued at 6% instead of at your whatever your stated rate on your coupon. If you're getting 4%, okay, if you're getting $400 a year on a $10,000 bond, what does that mean? That means that that bond actually has a face coupon rate of paying you 4%, but now interest rates are at 6%. That's bad news if you're holding a 10-year bond, okay? Even though you're not going to cash it in, if all of a sudden tomorrow afternoon you have a medical emergency, you got to cash in the bond, it will be bad news, as we'll see in 1 second. We want to know what the bond value now is. The first rule is you've always got to compare apples to apples. So that means you've got to convert your quarterly rates into, your annual rates into quarterly rates for everything. Your yield, this is a yearly rate. We stated that all market rates for a year are 6%. That means for a quarter they're all 1.5%. So we have to take the 6 and divide it by 4. On my calculator, I don't put in fractions. I actually put in the interest rate because my calculator convention, the way it's set up, is it just says, Dave, you don't have to put in fractions. If it's a 1.5%, just put 1.5 in there. That's the way my calculator is set up. Okay. Payment, what's the quarterly payment? If it's $400 a year, it's $100 per quarter. Okay, so that's the payment. We're going to do everything quarterly to figure out, what the bond value is. If it's a 10-year bond, we have 4 times 10 is the number of periods in this bond. You're going to get 40 interest coupon payments. 40 is in. Payment at maturity, municipal bonds aren't like mortgages or car loans. They're not amortizing. All the principal of the loan is paid on the maturity date. So every payment of coupon is just interest. At maturity, you get principal. Okay, all right, so that's paid at maturity. I hit FV, that's future value for that. That's an FV. Okay, just to make this clear. That's the FV button. All right. Okay, so these markers dry out pretty fast. Okay, so then I click on present value. That's what CEO means, click on present value, and I come up with, actually on my calculator, that comes up to negative 8,504.20. But I don't want to confuse anybody, so I just put 8,504.20. That is what, the market out there is going to price your bond as. Because it's heavily traded and everybody knows that yields now are 6%, are no longer at the 4%. So they're only going to pay you $8,500 for your $10,000 bond, so obviously that's a loss, right? Now what happens if rates stayed today at 4%? Well, you would convert the quarterly rate of 4% into 4 quarters, which is 1% each quarter. If we calculated and inserted all the other same numbers, we would calculate today's yield at, or today's current price at $10,000. Well, that's what the bond is. Well, interest rates haven't changed, so it's going to be worth exactly $10,000. If, on the other hand, interest rates go down to 2%, and we took 2% divided by 4, that means the periodic rate per quarter, now it's not, we're converting the 2% yearly into quarterly, which is 0.5%. If we calculated the present value then, the present value of the bond would be $11,808. It's worth literally $1,800 more because the interest rates out in the market are less than what's on our bonds. So our bond's more valuable than what we paid for it. This is true even of Treasury bonds if you are going to sell it before its maturity. Okay, now just to show you how maturities, I just looked what would happen. All of a sudden, I kept the same interest rate, 1.5%, okay? If I kept the same interest, this is based on 1.5%, okay? So all these are based on a 1.5%. All these based on this 1.5% rate. If it was a 1-year bond and rates went to 6%, but if it was a 1-year bond instead of a 10-year bond, the present value would be 9807. If it was a 5-year bond instead of a 10-year bond, present value would go to $9,141. These numbers on my calculator again come out negative, but they're actually positive numbers. Okay, if it's a 15-year bond, if it was a 15-year bond and interest rates went to 6%, and I had a 4% 15-year bond and interest rates went to 6%, its value would be $8,031. If the bond was a 20-year bond and interest rates went to 6%, from my bond is 4%, the value is $76.79. If it's a 30-year bond, my bond's worth a measly $72.25. See how the longer the maturity of the bond, the greater the risk that if there's a change of interest rates, then I'm going to take a bigger and bigger loss. If interest rates went the other way, down below my 4%, if interest rates here, the yield to maturity in the market went to 2%, these numbers would all be above 10,000, and out here at 30 years, I would make the most profit, and I would make the least, this would be profitable too, but it would be the least profitable. As the maturity went out, you would see the profits go up. So that shows you the maturity, the longer the maturity of the bond, the greater the risk of loss, but also the greater chance for appreciation, and that's true even for any bond, even though your interest rate is stable and set, and even if the federal government guarantees it. So that shows you how bond values trade. Now remember, if you own a mutual fund with a lot of bonds in it, they go through this stuff every day with all their bonds. And that's why they have gains and losses in your fund value, is because of this sort of situation happening. Okay, all right, so if we want to know how to calculate yield to maturity, basically the yield to maturity is nothing but if we made all the cash flows that come in and we wanted to make the present value of all those future cash flows equal to what we paid for the bond, what interest rate does that calculate out to? It's really an internal rate of return equal to 0. An internal rate of, the yield to maturity is sort of the internal rate of return of the bond. It brings the net present value of the bond at that rate to 0. I think that's right. Yeah, anyway, so yield to maturity. If we have a par bond of $10,000 with a yield to call, now here's something. If you have a 30-year bond with, let's say it's 25%, great bond, and it's 30 years. I got a bond for 30 years for 25%, that would be tremendous, wouldn't it? But the problem is, bonds that have great deals like that for long term, they always have a call provision where they allow the bond issuer to call the bond away from you and purchase it from you at a price which is usually called the call price. In this case, it's $10,500 on a $10,000 bond. The yield, they give us the yield to call on this, which is if the bond is called and it is and they pay the call price, what would your yield have been on that bond? That's what the yield to call is. And normally with a bond that's callable, that's normally for the issuer's protection, the company or the government's protection, not yours. Normally, you're going to end up on that bond getting the lesser of the yield. You're going to get the lesser of the yield to maturity or the yield to call. Now, you can still make a profit on these. Don't get me wrong, but what they're saying with the yield to call is they'll only take so much of the issuer will only take so much of a hit before they can get out of the deal, but if they do, they normally have to pay you a premium. Notice in this case, the par value of the bond is $10,000 and the call price is $10,500. That means they're going to pay you $500 more than the face value of your bond to get out of the deal. Okay, so we want to calculate the yield to maturity. In order to calculate the yield to maturity, we have to know what today's price, what today's value is of the bond, okay? Now in this case, the term is a 15-year bond, but it's callable in 10 years. So they've got to go through with the deal and stick with the deal for 10 years, the issuer does, and pay you at the coupon rate, which is 10% semi-annually. But in the 10th year, if they're sick and tired of paying you because interest rates have gone down to 1% and they're still paying you 10% on your bond, this is a yearly rate right here, okay? That's 10% per year, but the coupon payment is semi-annual, okay? All right. Yeah, all right. Okay, all right. 10% a year. Okay, so 10%, right? Yeah. Okay. All right. So now we've got to figure out figure yield to maturity. We have to know today's price of the bond. To figure that out, today's price, we have to do the apples to apples. We have to get all of our semi-annuals and quarterlies and yearlies on to the same terms. The rate is 3.25, which is the yield to call rate divided by 2, because this was semi-annual. This was a semi-annual payment bond, all right? This was a semi-annual bond. In other words, it's paying interest twice a year, okay? So we have to get that down to 3.25. The payment on $10,000 for a 10% bond is what? It's $1,000, right? So that means the payment semi-annually is $500, okay? All right, now, if it's callable in 10 years, 10 times 2, that's 20 periods away. You're going to call it at the call price, which is $10,500, not $10,000. If you calculate, click on present value button, you're going to get my calculator. This number is going to be negative, but it's actually a positive number. The value today of the bond is $12,808. Now, if that's the present value of the bond, we can figure out what the yield to maturity is. This is today's price. If we went out on the market, that would be what today's price is, because everybody else would have done that calculation. All right, the present value of the bond, you always have to know today's price if you're going to calculate yield to maturity, okay? That's today's value. Now, the convention is if you do this calculation, you have to put in both what goes out, the money going out. That's why I make this number a negative here, okay? Because that's what you pay. Somebody's going to pay for it. That the buyer's going to get $500 in interest payments for 30 periods. Because now we're going out for the full term of the bond. What year? The bond is 15 years, right? And that means 30 is 15 times 2. All right. Future value, if you hold it to maturity, is $10,000. You do the calculation, click on the interest rate, figure the yield to maturity. It's 3.477, but that's a semi-annual rate, so you have to double it to get 6.954%. Okay? That's a yield to maturity calculation. Okay, now we're going to calculate yield to call. Like I said, if you buy a bond with a call provision, not all bonds have call provisions, most of them do probably, but if you have a call with bond provisions, just trust one thing, you better calculate that yield to call simply because you are not likely to ever get a yield to maturity very much, if anything, above yield to call. There are certain transaction costs involved in calling bonds, and for that reason you might make a little more than the yield to call, but you better assume that you're only going to make the yield to call on that bond regardless of what the rate is on it, okay? The yield to call, all right, face par value of the bond is $10,000, okay? Coupon 9%, call price $10,450, so that's $450 more than the face amount of the bond if they're going to call the bond. 12-year maturity, yield to maturity 7.5%. So that's what's the prevailing interest rates for those kind of bonds on the market for other bonds is 7.5%. So that's all you're likely to be valued at in terms of your bond if you've got to sell it early and not wait to the maturity date to get your money. Okay, what's the yield to call? Well, you got to calculate the current price first. These are the inputs. You get the present value. That number on my calculator is negative, but it's not a negative number. That's actually the value. Then you calculate the yield to call. Now you have to put in the call information, okay? The call price down here, and that's the regular maturity amount. Down here you have to put the call price in, which is that. And now you got to have, it's callable in 4 years, which is 8 periods. You calculate it out, that gives you the yield to call. So even though the yield to maturity out in the market is 7.5%, you're not likely to ever see much more than 6.62% yield on this bond. Okay? All right. So let me just check something here. Thank you. Okay, I have a little bit of time, which is excellent. So now, as promised, I'm going to cut to the chase, do something that is going to probably be a little more standard fare. Remember, from our first video on investing, the bonds are IOUs, meaning that you have a bond issuer, and the bond issuer, let's come over here. You have a bond issuer, right? And the bond issuer is a corporation. It could be the U.S. government. It could be the state, a state government, a local government. With regard to state or local governments, those are known as muni bonds. They are usually exempt from federal taxation. And if you buy a muni bond in your own state, not another state, if you buy a muni bond issued in your own state, it's also usually exempt from state income taxes. Consult with your tax advisor. Okay, now we talked about federal government bonds, which are allegedly risk-free, but we just saw how you can lose money on those. Even though the federal government hasn't defaulted on those bonds, you can still lose money. We just saw that on those, or you can make extra money. So, and that's because what you have here, the bond issuer, and this could be the government, right? And they're going to pay you two types. This is you, the investor, okay? They're going to pay you principal or interest payments, right? But if this is the bond market, and it has lots of buyers and sellers, So if you can't hold like your 10-year bond for 10 years and you want to get out and sell in 5 years, you go to the bond market and you sell the bond, okay? Or you could have bought the bond out in the bond market to begin with instead of directly from the issuer. But if you're over here, you're going to have either capital gains or capital losses. And we talked over here are going to be capital gains or capital losses, okay? The regular coupon payments, which are the interest payments, are from the issuer. Okay, all right. So, now let me just say this, all right. The ratings, in terms of your risk of making or losing money on the bonds, trading it in the secondary market out there in the bond, are governed by, the rules. There's no free lunch in investing. Risk reward, okay? As reward goes up, your risk goes up, right? There's no exceptions to that rule. What determines this? Liquidity? Well, for bonds traded on the public, over-the-counter, the bond market, they're liquid. So you don't have to worry about that too much for publicly traded bonds. But always ask. This is the biggie, default risk. Liquidity, default risk, and here we're talking like S&P, we got Moody's, we got, who else? There's another, excuse me, I'm sure I'm missing, anyway, I can't, it's not sticking with me right here at this Duff and Phelps. Oh yeah, Duff and Phelps, sorry, okay. All right, so there's the risk of default. These things, these are all risk things, okay? Default risk, the maturity risk, and this is what we were talking about over here, the term, how longer terms, the bigger the maturity is, the more risk, okay? Now these guys, S&P, Fitch's, Moody's, Duff, they're not telling you when they rate something excellently, like a AAA rating or something, or double B or whatever, they're not grading the investment. They're talking about, or whether it's a good investment or bad investment, they're talking about only about default risk. They're not talking about this risk or this risk. So you need to very much remember that. Another thing is that some bonds have collateral, like they're backed by mortgages, for example. You may want to ask that because it goes to this default risk. You may want to ask that, like mortgage bonds, mortgage revenue bonds issued by the municipal agencies, sometimes Ginnie Mae's. And then, of course, you have what's known as your interest rate risk. And that is very tied to the maturity and the coupon rate on the bonds, as we saw over here. So we talked about yield to maturity, but as risk goes up, just remember one thing, as risk goes up, normally for new issues, as risk goes up, normally the coupon that's for the new issues is going to go up, but definitely as market yield to maturities are dependent on what the market says for similar types of bonds. And as yield to maturities go up, values of bonds go down, right? And as yield to maturities go down, bond values go up. Always remember that. I hope that this elaborates things for you. And I'm Dave Lentz. Thanks for visiting. See you next time.